Right, let's have a look at a bullish pattern now. So bullish patterns are the reversal patterns in Japanese candlesticks. So if I am bullish on the market, which means I want to buy in the market. So reversal pattern, understand that reversal pattern does not mean that the prior downtrend is going to completely reverse or the prices will go from down to up immediately. Reversal simply means that if there is a downtrend in the market or if the prices are coming down, then reversal pattern shows us that, tells us that either the price will go flat or it will go up completely. The reversal pattern doesn't mean that the trend is immediately going to reverse, and we will look at this with examples so that you will be able to understand. But just for now, just understand that reversal doesn't mean that the trend will go from down to up or up to down. Okay, reversal means that the prior trend is likely to end. Okay, so have a look at this pattern. Okay, this is a bull candle. Now the distance between the high and the low is called as the trading range. Any candle you take, whether it is doji candle or a bull candle or a bear candle, the distance between the high and the low is called as the trading range. So now let's analyze this candlestick pattern and why is it important to why is it important for us during our trading. So it's a single candle bullish pattern. So it's just one candle and it's a bullish pattern, which means that after I see this pattern, I am likely to take a long position, okay, as a professional trader. Lower shadow must be at least twice the height of the real body. So this is the criteria of the hammer. This candle is called as a hammer because it looks like a hammer, okay. And remember one note here, side note, that candlestick patterns are proven, tested, documented, and this science is more than 200 years old. So these patterns which we are discussing here are already tested patterns, so there is no subjectivity in this. So all of these rules are very rigid. You have to follow these rules. Unless these rules are met, you cannot call this as a hammer. Okay, so strictly follow these rules. So lower shadow must be at least twice the height of the real body. So the lower shadow, so the distance between the open and the low. So this is the lower shadow. This distance, let's call it A, and this distance, the height of the real body. So that's the real body, that's the upper shadow, that's the lower shadow. So let's call this B. So what this point is saying is that A should be at least twice of B. Okay, if it is more than twice of B, it is even better. Okay, so here just by eyeballing it, we can tell that the lower shadow is more than twice the height of the real body. It must come after a downtrend. So if the hammer is coming after an uptrend, it is that if you see this candle after an uptrend, it is not a hammer. When you see this candle after a downtrend, only then we can call it as a hammer. Otherwise we cannot call it as a hammer. Okay, next, it should preferably have no or very small upper shadow. So this upper shadow that you see here, it should preferably be small, or if there is no upper shadow, it's even better, because remember I mentioned that upper shadow represents bearishness and lower shadow represents bullishness. So, and this is a bullish pattern, so we don't want any bearishness in a bullish pattern. So that is why this upper shadow, it should be as small as possible. The color of the real body does not matter. So if this color is white or black, it really doesn't matter. It's just that the real body should be near the upper end of the trading range. Trading range is the distance between the high and the low. So the real body, even if it is white or black, doesn't matter. It should be near the upper end of the trading range. If this body is somewhere here, then that is not a hammer. Okay. The real body must be as small as possible. So the smaller the real body, the better. Okay. Because if the real body is small, then the lower shadow is likely to be large in comparison to the height of the real body, which is what we want from this point. And the low of the hammer becomes support. So This is where the bulls have pushed the price up. So the low of the hammer becomes our support area. Support area simply means that the bulls are not allowing the price to go below that level, and resistance simply means that if there is a resistance here, the bears will not allow the price to go above that level. So the resistance simply means like a ceiling of a room, and the support means that it's the floor of the room. Okay, so to quickly summarize, what is the hammer? It comes after a downtrend. It has a small real body near the upper end of the trading range. The lower shadow must be at least twice the height of the real body. The real body should be as small as possible, and the upper shadow must be as small as possible. The lower shadow must be as long as possible. That's the only criteria. It's very basic. Just by looking at this, you will know that it's a hammer. Okay, let's quickly have a look at an example, and this will tell you how powerful these candlestick patterns are. So number one, see, this is a daily chart of Asian Paints. So each candle represents price action for a day. Okay, that is one thing. This is a chart of Asian Paints stock. The x-axis is the timeline and the y-axis is the price of that stock. This is an example of a hammer. So the blue arrow is showing you that the price is coming down. Okay, so the price has gone from 1000 to near 850 now. Okay, you see the price has been 1000 here and now it is at 850. Okay, and we are somewhere in the third week of December. This is where December is starting. So you have a pattern here. This is called as the hammer. Because it looks like a hammer, it satisfies all the conditions of a hammer. You can go back and see the conditions in this video, but this satisfies all the conditions of the hammer. So if I buy here, I will have to buy at the closing point of this candle. So the closing price of this candle is this here. Okay, every candle has an open, high, low and close. So that's the closing price. So that's where I will buy or I will take a long position. The low is where the bulls have pushed the price up. So the low will be my support. So I will keep my stop loss below this, the low of this candle. So the stop loss is nothing but a way of protecting my position, because if the price goes below this low, that means I don't want to be in that trade if the price starts to go below that point, because what I am saying is that this is a single candle bullish pattern. Okay, so I don't want my losses to multiply. So this is a way that Japanese candlesticks allow us to cut our losses short. So I told you before that the Japanese candlesticks are very precise in terms of giving us the market entry exit levels. So now I have a clearly established entry point. I also have the stop loss. This is my exit point if the price goes against me, and then I can expect the prices to go up. Now if you see how aggressively the price has gone up here, just a single Japanese candlestick forecasts this huge rise in prices. The price has gone from 850 back again to more than 1000. So understand that simple patterns like this, which even school kids can identify, are so powerful in forecasting price movements in the future. So now the hammer doesn't necessarily mean that the prices will go up. The prices could easily have gone sideways. In this case, it has gone straight up, but the reversal pattern that the hammer is just showing us, is just telling us that the prior trend, the downtrend, is likely to end, which is what happened here. And the chances of the prices going down are very low because the bulls have already pushed the price from the low of the hammer. Okay. Another point to mention here is that my coach Steve Nissen says that candlesticks are a tool, not a trading system. They don't give us a price target. So for that we have to rely on Western technicals, which we will discuss later. How to put price targets, I will discuss that. But just understand that this single candlestick, which is as simple as the hammer, is able to forecast such a huge rise in price. That is the power of Japanese candlesticks. Okay.